In this week's video, we'll review numerous present-day and historical charts to help us answer the question, are the economy and markets starting to roll over? To view the video in full screen mode, use this icon in the lower right-hand corner of your video player. To improve the clarity of the charts, use this icon in the lower right-hand corner of your video player. We'll kick off the video by expanding on last week's topic. Last week's video compared 1995 to the present day. We don't have time to review the concepts from last week, so if you haven't seen the video, you can find it by Googling this title here. Clients and regular viewers may remember that we covered a signal that had only occurred 10 times in the past 35 years back on August 19th of 2016 using the, for illustrative purposes only, 30-week, 40-week, and 50-week moving averages shown here on your screen. You can find that video by Googling this title. Two relevant questions since we covered that video back in August. Has the market surprised on the upside since August of 2016? Does it seem like the market's character has changed since August of 2016? I think if you answer those questions honestly, the answer is yes, and that aligns exactly with the analysis that we did in August of 2016. A similar setup occurred in the mid-1990s after we saw the bullish signal. In that case, the S&P 500 rallied for 235 weeks or 4.5 years, and you can see during the entire rally, we maintained a full-bore bullish look despite normal and 100% to be expected volatility from point A to point B. I think if most of us paused our video player right now and we were asked the question, which of these two charts is the present day and which of these two charts is 1995, I would guess most of us would have a tough time discerning between the two because they look so similar. These are both weekly charts with the 30, 40, and 50-week moving averages. You can see 2016 back in December of last year looked incredibly similar to April of 1995. Our gut would tell us that there's no way the present day is going to rally in a similar manner to the rally that occurred in 1995, 1996, 97, 98, and actually all the way into the year 2000. Therefore, it might be helpful to cover some similarities and differences between the two periods. The breakout in the NYSE occurred in 2017 from this long-term consolidation box, and it occurred in 1995 if we use the NYSE composite here. In both cases, we're looking at charts 90 days after the breakout from the long-term consolidation box. In this case, the chart's dated May 11th, 2017. 90 days after the breakout from the box in 1995 was June 22nd, 1995. We can compare and contrast investor psychology in June of 1995 with the present day or May of 2017 by looking backwards. If we look backwards from the same point, if we go back 3,500 days from this point here and 3,500 days from this point here, we can see that the stock market gained 154% from point A to point B. Over the same 3,500 days looking backwards, the gains were extremely tepid, only 13% from point A to point B. If we move from 30,000 feet to 60,000 feet and look backwards from 90 days after the breakout, 90 days after the breakout, and we go back 6,094 calendar days in both cases, the 457% gain from October of 1978 up to 1995 relative to the tepid 61% gain from September of 2000 into 2017 can tell us quite a bit about investor psychology. Kathy and I both started at Morgan Stanley in the mid-90s, and we can both tell you that the present day pales in comparison relative to the importance of the stock market in the mid-1990s. And that makes sense. When we look backwards from this breakout here, investors had already captured wonderful gains looking back 3,500 days. In the present day, the gains have been extremely tepid, and there's a lot of sleepless nights in here to capture the 13% gain in the NYSE composite. A quote here from the Los Angeles Times. It appeared in the Times on January 1st, 1995. Individuals invested a record amount in stock and bond mutual funds in 1992 and 1993. Gross fund purchases totaled $876 billion in those 2 years, nearly as much as was purchased in the entire 1970 to 1989 period. This is roughly 19 years here relative to 2 years here. You can see investors were incredibly interested in the stock market relative to recent history at this point here. This speaks to the amount of fuel that was available to propel the market higher from Fast Company. As surely as the 1990s was the decade of the digital revolution and the stock market's skyrocketing performance, the 1990s was also the decade of CNBC. No matter where you went in the mid-1990s, if there was a TV around, there was a good chance that it was tuned to CNBC. In the present day, if there's a TV in a public space, the odds are extremely low that it would be tuned to CNBC. It might be tuned to HGTV in the present day, and that tells us a lot about where the stock market is in the American public psyche. When this breakout occurred here in 1995, an incredible amount of money and individuals were pouring into the stock market. It was incredibly popular. How does a stat like this compare to the present day? I believe Gallup does this poll once a year. This is last year's poll, April 20th, 2016. Just over half of Americans own stocks, matching the record low. They've only been doing this poll since 1999, but you can see the stock market in 2007, when it peaked, 65% of U.S. households were invested in the stock market. And you can see since then, instead of people pouring money into the market as if it were a bubble, people have been leaving the stock market, and this has been in a steady decline. This speaks to the potential fuel that could push the markets higher over the next few years relative to the fuel that had already been expended here in the mid-1990s when this breakout occurred. Remember, we're talking about the psyche or psychology of investors. Gallup also found that middle-class adults and those younger than 35 were less likely to invest. The fact that in the present day, those 35 and younger are less likely to invest passes the common sense test. This poll was done in 2016. If you were 25 to 35 years old in 2016, that means you were 9 to 19 years old when the dot-com bubble burst, which was in the year 2000. We all know that we're very impressionable between 9 and 19. If you were between 17 and 27 in 2016 when this poll was done, that means you were 9 to 19 years old when the financial crisis took place in 2008. Once again, very impressionable between 9 and 19. It's very, very easy to understand why in the present day, people between 17 and 35 do not have a very optimistic view about the stock market. They have lived through 2 horrible 50% plus decline bear markets. How is it possible for the psyche to turn around and to get this number to start climbing again? Good news travels fast, and as returns start to improve, those who are not in the market will get tired of hearing about those that are in the market. They'll get tired of hearing about how much money they're making. The returns will bring additional interest. Instead of having bad memories about the stock market, they will begin to get possibly positive feedback about the stock market. And remember, we've covered numerous times, markets operate more on psychology than on fundamentals. Fundamentals are important, but psychology may be even more important. And if the market starts to perform and this breakout holds, then the psychology of people between 17 and 35 would most likely improve, and this number might start climbing again, providing fuel. You can make an argument that there is more fuel available, and the psyche is at a much lower level in the present day than it was when the stock market broke out in calendar year 1995. We also know the longer a market goes sideways, the bigger the move that we can expect to get when we either get a bullish breakout or bearish breakdown. In 1995, the NYSE Composite was inside of the box for 640 days. Compare and contrast that with the 1,434 days that the NYSE Composite stayed inside of this box recently between 2013 and 2017. The longer a market goes sideways, this is much longer than this, the bigger the move that we can expect to get when we get either a bullish breakout or bearish breakdown. I think you can make an argument based on fuel, psychology, and the time inside of these boxes that it's possible, within the realm of reason, that what we have in front of us now may last longer and go further than what we saw from 1995 to 2000. It's not a forecast, it's just simply a hypothesis. If we have a better understanding of the potential reward if we're able to navigate from point A to point B, it can help with the discipline, the incredible amount of discipline that's required to get from point A to point B. As we do this, let's keep in mind that the present day has a lot of similarities that we've covered to 1995, and those that had enough discipline to treat this as volatility to ignore from point A to point B were rewarded in a big way. Checking your P&L and your performance versus the market on a daily basis gets you focused on the short term. Let's talk a little bit about the long term, which is really where the big money is made in the markets. From 1995 to the peak in 2000, the Dow increased by 205%. The S&P 500 moved up 234%. From 1995 into about mid-year 1998, banks went up 251% if we use this mutual fund as a proxy. This energy services mutual fund, 1995 into late 1997, was up 261%. And after we saw the bullish breakouts and move to a full-bore bullish look on the S&P 500 and NYSE Composite, the NASDAQ moved up 533% from point A to point B. The point of the exercise, when you get a market like this, the trends can be very strong and they can last for a very long period of time, and the returns can be somewhat eye-popping. Let's talk a little bit about what is required to get from point A to point B. For Market Wizards, I think investment psychology is by far the most important element, followed by risk control, with the least important consideration being the question of where you buy and sell. I agree with that quote wholeheartedly. 90% of the effort is spent here when 90% of your effort should be spent here and here. If you're invested with the primary trend, for the most part, this takes care of itself. The vast majority of investors absolutely, positively do not capture market returns. And if they do, they give them back when the bear market comes or they experience huge drawdowns. Why is that the case? Let's use some analogies. This is a quote from a book, Fit or Fat, and I'm paraphrasing here. This is the author, Covert Bailey. If pharmaceutical companies could develop a skinny pill, a pill that we could take that would make us skinny, it would be the most successful drug in history. Well, I'm here to tell you a skinny pill does exist. It just takes an hour a day to swallow it. We all know the benefits of eating well and exercising regularly. We also know the statistics on obesity in the United States. Those statistics tell us, despite the pill that's available to everyone, few have the discipline to swallow it every day. From the book, Chop Wood, Carry Water, How to Fall in Love with the Process of Becoming Great. The author says, everyone wants to be great until it's time to do what greatness requires. For the most part, it's probably fair to say that everybody wants to be skinny, everyone wants to be great, and everyone wants to make 250% in the stock market. Before we ask a question about these charts, let's go back to this quote, which says, investment psychology is by far the most important element, and the least important consideration is the question of where you buy and sell. So think about this quote in the context of this question. How many trades were required to capture the returns from point A to point B to earn 205%, 234%, 261%, 533%, and 251%? How many trades did we need to make? The answer? 0. These are buy and hold returns. Which brings us to our next point. How much discipline was required to capture the returns from point A to point B? If you've traded your own account or invested in the market on your own, you know the answer to this question. The answer is an incredible amount of discipline. Just as an incredible amount of discipline is required to stay in shape, just as an incredible amount of discipline is required to perfect your craft. Now we're revisiting our move. This is just a bigger chart, S&P 500, 1995. This is the peak before the dot-com bubble burst. This is our 234% gain. This looks easy when we look here, but there's an incredible amount of emotional stress and discipline that's required to get from point A to point B. And we know from past videos that trend following techniques can help us. For example, during the entire move from point A to point B, the slope of the S&P 500's 200-day moving average remained positive, telling us that the bias was for the long-term bullish trend to continue. And we know it's much, much easier to make decisions off of an input like this relative to the difficulty of making decisions solely based on incredibly volatile price. Fair question might be, if we have strong trends today, what is the possible downside to blind buy and hold? Well, the answer is bull markets and bullish trends eventually give way to bear markets and bearish trends. And the million-dollar question is, and no one knows the answer to it, including us, how long the long-term bullish trend will last. Eventually, your trend rolls over. Therefore, to answer this question, we can't make an assumption that this is similar to the present day and good things are going to happen for 5 years. It's possible that this point here historically is similar to the present day, where we have a bullish trend in place that's followed by a deterioration in the hard evidence and a big decline in long-term bear market. All we can do in the present day is look at the data that's in front of us. We can't predict how it's going to change in the future. In this case, when the 200-day moving average finally rolled over, I can see this, I can measure it in a model. The S&P 500 after this point here lost an additional 46.46% from point A to point B. There's nothing wrong with buy and hold. You just need to know in advance how significant and big the drawdowns can be, and that includes if you're in a diversified account. For the most part, all stock mutual funds and all stock ETFs are correlated, and when something like this happens, even a diversified pie chart typically is going to get hit as well. From a probability perspective, trend following techniques can help us get from point A to point B, And from a probability perspective, trend following techniques can help us mitigate a loss from point A to point B when that inevitable bear market finally arrives. Let's quickly compare and contrast what happens if the present day looks more like this period here, or what happens if the present day ends up looking more like this period here. Let's assume you invested $1 million and you were fortunate enough to capture the gain from point A to point B. In the case that we just covered, that was 234%. Your $1 million would be worth $3.3 million. If I retired after this gain and tried to draw an annual income at 6%, off of $3.3 million, I could draw roughly $200,000 a year. Compare and contrast this scenario with the bear market scenario we just showed. After the 200-day moving average rolled over, the S&P 500 lost an additional 46%. So instead of ending up with $3.3 million, it's possible your $1 million could turn into $535,000. If you retired at this point here, instead of getting $200,000 a year in income, your income might fall to $32,000. And you may say, this is absolutely ridiculous. The stock market's never going to lose 78%. Well, that's not true. The NASDAQ and the dot-com bust, the NASDAQ, the entire index, from the high to the low, lost 78%. So if you're heavily invested in tech stocks with no game plan to exit, it's possible, if history repeated itself, that $1 million could turn into $215,000, and your annual income at 6% would be $12,000, or roughly $13,000. The long-term trend can have a dramatic impact on the size of your portfolio and potential income later on. Even if we're fortunate enough to see something similar in some way to 1995 to 2000 over the next 5 years, as we discussed last week, it's never easy to get from point A to point B because of the volatility and emotions involved. One of the reasons why we covered the list of common missteps is if you set proper expectations, it's much, much easier to get from point A to point B. I think another common misconception and misstep is constantly checking the performance of your portfolio versus the market. Just like many of these common missteps here, it gets you focused on short-term volatility and short-term time horizons and gets your eye off the ball, which is the longer-term time horizons. You also have to ask yourself, is the market the standard you always want to measure yourself against? Here are 3 questions. What type of risk do you have to expose your capital to get market or better returns? If we beat the market, would that be considered good performance? Is there a more prudent goal? If you always want market returns or better, then you, for the most part, have to accept market risk or better. In the NASDAQ's case here, as we discussed, from point A to point B, the risk was huge. It was a 78% loss. Relative to this question, if we beat the market, would that be considered good performance? Beating the market would be a 76% loss over this period. Obviously, nobody wants a 76% loss, and beating the market during a bear market is not necessarily a good thing. And during a bull market, a quote like this, I can get market returns with an index fund and a 100% of the time buy and hold approach. That's very, very true. And you will also get market returns during the bear market, which might include a 40 to 70 or 80% loss. Buy and hold works until it doesn't. Back to, is there a more prudent goal? The objective of the market model is not to beat the S&P 500 every day, every week, every month, every quarter, or even every year. The realistic objective is to beat the market over a full market cycle. Here's an anecdotal example. We would like to beat the market from point A to point B. It doesn't do us much good to secure a 234% gain if we allow our account balance to drop over 50% from point A to point B. It is very reasonable with trend following techniques to capture very respectable returns over here when the odds are in our favor, and to mitigate the damage when the observable evidence shifts and the odds are against us. So I think it's fair to add another bullet point. Everybody wants to be skinny, everybody wants to be great, everybody wants to make 250%, and everyone wants to mitigate the damage from bear markets. What does greatness require in the stock market? The answer is we have to tolerate drawdowns, emotional distress. We have to have an incredible amount of patience and discipline, and we have to make decisions based on hard evidence rather than emotions or account balances. Because if we can stay near fully invested for the most part during volatility to ignore, and we can migrate to a defensive stance during volatility to respect, it can make a huge difference in the long term from a point A to a point B. Our quote from Market Wizards pretty much sums it up. It's not the mathematical skill that's critical to winning, it's the discipline of being able to stick to the system. Let's look at some present-day charts, and it will really shed some light on this quote. Our original thesis was that a long-term trend might be starting with a look like this. As of May 11th, has anything changed? Nothing's changed. There's no great mathematical skill to see that, but there's an incredible amount of discipline required to stay invested during the pullbacks. Michael Batnick, you may know him as the Irrelevant Investor, has an excellent quote. Buying and holding sounds easy, but because of the drawdowns, without a plan, it's almost impossible. Think of the emotional distress that takes place when you get drawdowns, even during an easy-looking trend like this. Just wait till things get more difficult. It is going to require a plan and an incredible amount of discipline. If the S&P 500 looks good in May, how about some ETFs? Here's SPY, the same 30, 40, and 50-week for illustrative purposes only moving averages, May 12th. Regional banks, KRE, May 12th. XLF Financials, May 12th. Small caps, base metals, SP high beta or economically sensitive sectors. Is there anything on these charts with our trends or our moving averages that says anything has changed? This is an early stage look, early stage turn, early stage turn, early stage turn. Remember, after a similar early stage turn, the S&P 500 rallied for 4.5 years from point A to point B. And during the entire move, despite the volatility, the S&P 500 maintained a full-bore bullish look, and that's where the plan comes into play. It's also prudent to ask ourselves, do any of these ETFs in the present day look anything like the moving averages during this higher risk period here in the year 2000, or anything like the early stages of the bear market here in early 2008? This and this really doesn't look like any of this. How do we track all of this and convert it into a usable and actionable format in a reasonable amount of time? The submodels, we answer binary questions, some of them manually done, some of them programmed in Excel, and we also enter in unbiased and hard data. The submodels allow us to get a handle on the market's current profile, and the master CCM market model then looks at the current profile, compares it to past profiles, and recommends a prudent allocation between risk assets such as stocks and conservative assets such as bonds. Conservative assets can consist of cash, bonds, currencies, or any number of investment options. If you'd like to learn more about the market model or our money management services, you can visit our website, follow along on Twitter, Facebook, read our blog Short Takes, or watch past videos on the Shavaco Capital channel on YouTube. The material in this video has no regard to the specific investment objectives, financial situation, or particular needs of any viewer. This video is presented solely for informational purposes and is not to be construed as a solicitation or offer to buy or sell any security or any related financial instruments, nor should any of the content be taken as investment advice. Any opinions expressed in this video are subject to change without notice, and Shervacco Capital Management, LLC, or CCM, is not under any obligation to update or keep current the information contained herein. CCM and its respective officers and associates or clients may have an interest in the securities or derivatives of any entities referred to in this material. CCM accepts no liability whatsoever for any loss or damage of any kind arising out of the use of all or any part of this material. We recommend that you consult with a licensed and qualified professional before making any investment decision.